Ticker symbol TSLY, or the Yield Max Tesla Option Income ETF, has been all the hype as of late, especially for more income-focused investors. Now, this is obviously because the ETF is apparently offering a distribution rate of over 69%, which definitely caught my attention the minute I heard about it. But when it comes to the Option Income ETF, there are a few important, potentially misleading facts that I uncovered recently, and I definitely want to share them with all of you. Then later on, I'm going to give you my true opinion about this high-yield ETF, and if or if not, I am planning on buying any more of it anytime soon. Now stick around because we have a lot to go through. Right after you, please drop a like on this video and subscribe for more future videos like this. Now, wasting absolutely no time heading over to the Yield Max ETF website, it says TSLY, the Yield Max Tesla Option Income Strategy ETF. And the fund overview seems pretty simple. It sounds like any other covered call ETF. It says the Yield Max Tesla Option Income Strategy ETF, TSLY, is an actively managed fund that seeks to generate monthly income by selling and writing call options on Tesla. TSLY pursues a strategy that aims to harvest compelling yields while retaining cap participation in the price gains of Tesla. But if we want to uncover exactly how this ETF actually works, it's important that we dig into the literature, and that's exactly what we're going to do next. So now we get to the good part inside the TSLY prospectus. It says Yield Max Tesla Option Income Strategy ETF Fund Summary. The investment objective is the fund's primary investment objective is to seek current income. The fund's secondary investment objective is to seek exposure to the share price of the common stock of Tesla, subject to a limit on potential investment gains. Next, it talks about the management fees, and because this is an actively managed fund, the fee is actually very, very high, at almost an entire percent, 0.99 to be exact. It then says principal investment strategies. The fund is an actively managed exchange-traded fund that seeks current income while maintaining the opportunity for exposure to share price, i.e. the price returns of the common stock of Tesla. Now, TSLA, subject to a limit on potential investment gains. The fund will seek to employ its investment strategy as it relates to TSLA, regardless of whether there are periods of adverse market, economic, or other conditions, and will not seek to take temporary defensive positions during such periods as further described below. So the principal investment strategy is basically saying that they have a strategy, they're going to stick to it, and they're not all of a sudden going to switch up the strategy if there are, for example, adverse market events. So that's pretty clear and straightforward and definitely good to understand, just to know that there's not going to be a potential extra hedge placed on the ETF, etc. It then says, as further described below, the fund uses a synthetic covered call strategy to provide income and exposure to the share price returns of TSLA, subject to a limit on potential investment gains as a result of the nature of option strategy it employs. The fund's option contracts provide exposure to share price of TSLA, Tesla, also current income from option premiums, and a limit on the fund's participation in gains, if any, on the share price of Tesla. So that might be one of the first red flags that I don't think a lot of investors necessarily understand, that the fund actually uses a synthetic covered call strategy. So if you don't happen to be aware of what a typical covered call strategy is, a covered call involves sellers offering buyers a call option at a set price and expiration date on a security that the seller owns. Now, just like I said a second ago, a covered call normally involves selling options on securities that the seller owns. And just like we saw a second ago in the case of TSLY, they don't actually own TSLA. They use a synthetic covered call strategy to provide income and exposure. But reading on a little bit further, an investment in the fund is not an investment into Tesla. The fund strategy will cap its potential gains if Tesla's share price increases in value. Now, that's normal in any covered call situation. If the price of the security does move up in price by a lot, most likely the shares will get called away, so it's normal that there's going to be a cap on the potential gains of whatever covered call you're really selling. The fund strategy is subject to all potential losses if Tesla's shares decrease in value, which may not be offset by the income received by the fund. That's also pretty straightforward, basically saying that even if the fund does receive premiums, which are going to be pretty big because Tesla does have some pretty good volatility, if Tesla for whatever reason does decrease in share price by quite a bit, it doesn't necessarily mean that the premiums are going to make up the losses if Tesla decreases in price by quite a bit. It then says once again, the fund does not invest directly in Tesla, which again, in most covered call strategies, you are buying into shares of a stock or an ETF and then selling options on that. But in this case, the fund does not even own Tesla. Fund shareholders are not entitled to Tesla dividends or anything of the sorts because this fund does not own Tesla. So next, this is very important. This is getting a little bit deeper into the option use and of course the synthetic covered call strategy. It says, as part of the fund's synthetic covered call strategy, the fund will purchase and sell a combination of standardized exchange-traded, flexible, exchange or flex call and put option contracts that are based on the value of the price returns of Tesla. So basically what this fund is doing is they're utilizing calls and puts and synthetically creating a situation where they're receiving the potential upside of a situation of selling covered calls on Tesla without actually having to do so. It then says, in general, an option contract gives the purchaser of the contract the right to purchase for a call option or sell for a put option the underlying assets, like shares of Tesla, at a specified price, the strike price. The seller of an option contract obligates the holder to deliver the shares for a sold or short call, or buy shares for a sold or short put for the underlying assets at a specific price, again known as the strike price. Now, option contracts must be exercised or traded to close within a specified time frame, which is known as the expiration date. And of course, you can look a little bit deeper into this fund's calendar of expiration dates, etc. It then says the fund's option contracts are based on the value of Tesla, which gives the fund the right or obligation to receive or deliver shares of Tesla on the expiration date of the applicable option contract in exchange for a stated strike price, depending on whether the option contract is a call option, a put option, or whether the fund purchases or sells the option contract. So lastly, now looking into the synthetic cover call strategy, which a lot of you might have never even heard of such a thing as synthetic cover call strategy. For me personally, I sell cover calls throughout my portfolio, but I've never set up a synthetic cover call. So it says, in seeking to achieve its investment objective, the fund will implement a synthetic cover call strategy using the standardized exchange traded and flex options described above. A traditional cover call strategy is an investment strategy where the fund sells a call option on an underlying security that it owns, which again in this case, they do not own any Tesla. A synthetic cover call strategy is similar to a traditional cover call strategy in that the investor sells a call option that is based on the value of the underlying security. However, in a synthetic cover call strategy, the investor, the fund, does not own the underlying security, but rather seeks to synthetically replicate it 100% of the price movements of the underlying security through various investment instruments. Very interesting. It then says that the fund's synthetic cover call strategy consists of following 3 elements, each of which is described in greater detail below. Synthetic long exposure to Tesla, which allows the fund to seek to participate in changes up or down in the price of Tesla stock. Cover call writing, where Tesla call options are sold against the synthetic long portion of the strategy, which allows the fund to generate income. And lastly, U.S. Treasuries, which are used for collateral for the options and also generate income. It then says down below, there is no guarantee that the fund's investment strategy will be properly implemented, and an investor may lose some or all of their investment, which this sort of stood out to me as well. It then pretty much just goes through a bunch of legal jargon and talks about the risks of investing into ETFs, talks about Tesla, etc., etc. So now that we know exactly how the TSLY Yield Max ETF works, the fund strategy, and exactly how the fund is built, it does personally make me feel a little bit different about the fund, knowing that they're not actually buying into shares of Tesla and writing cover calls in it, but instead utilizing other option vehicles and pretty much achieving sort of the same thing. Now, there's no doubt that this ETF is definitely going to be interesting to watch from here on forward. With the trailing 12-month 47% dividend yield and somewhat rather consistent dividends paid for the most part over the past year, this ETF, in my opinion, is either going to make a lot of people rich or potentially could make a lot of people mad in the future. But like I promised earlier, I want to talk a little bit about if I'm personally going to be buying more shares of TSLY from here. Now, I currently throughout my portfolios have around 120 shares of TSLY, which in comparison to the rest of my portfolios is way less than even 1% exposure. But most likely moving forward, I'll still just buy a few shares of TSLY here and there until we sort of get more of a grasp on what's going on with this ETF. But I want to hear from you guys down below if you're personally buying shares of TSLY, and if anything we went over in today's video changes your mind at all about it. Comment down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.